Hello everyone, this is Tejashwini Chiranjeevi. In this video, we are going to discuss about the capital gains which is applicable for May 25 exam and onwards, that is basically AY 25 and 26. Test your knowledge questions and few important illustration questions. That too, illustrations we will do illustration 9, illustration 10 and illustration 13. We will do 3 illustrations and we will do the all the test your knowledge questions. Okay, great. So first, let's start with the question. Mr. Mithun purchased 100 equity shares of Good Money Co Limited, very well, on 1/4/2007. Okay, at the rate of how much? 1000 per share, and he has paid the STT also. The company allotted the bonus shares in the ratio of 1:1 on 1/12/2023, and he has also received a dividend for rupees 10 on 1/5/2025. Okay, he has sold all the shares on 1/10/2024 at the rate of 4000 per share, though recognized through the recognized stock exchange, and paid the brokerage of 1%, and STT is also paid. Very well. What if they ask you to find? This becomes the point which is very important. This becomes the point which is very important, that is compute his total income and the tax liability for AY 25-26, and this fellow Mr. Mithun is paying the tax under the default tax regime, assuming he is paying under, and he also has other income of 8 lakh. The fair market value of the shares of Good Money on 31/1/2018 is 2000. Okay, this is our question. Here we are going to cover section 112A with regarding to the amendments is also covered in this question, and we will do the solution for the applicable AY 25 and 26. Okay. So now this fellow, Mithun, this fellow purchased 100 equity shares on 1/7/2024 at the rate of 1000 rupees per share. Means if you multiply these 2000 into 100, this becomes your actual cost of acquisition. Actual money which you moved out of your pocket would be your actual cost of acquisition, right? Correct. Okay, the company allotted the bonus shares. See, when did this fellow purchase? On 1/4/2007. Very well. If you had purchased on 1/4/2007, is it long term or short term? Ray, how do you determine long term and short term for the shares here? Listed shares. If the shares are held for a period less than or equal to how many days? Less than or equal to how many months? 12 months, it is short term. If it is held for a period more than 12 months, it is going to be treated as long term. That is what we are going to look over here also. 1000 per month in this point, and this is going to be long term capital gain. The capital gain which you arise over here will be long term capital gain. And the bonus shares in the ratio of 1:1, no, on 1/12/2023. So, and he received a dividend also. Dividend is fine. That we will consider it as the dividend income under income from other sources on 1/5/2024. That would be how much? Bonus shares is 1:1. So you were already having 100 shares. So how many number of bonus shares you have issued? Bonus shares they have issued 100 more. So the total number of shares is 200. For the 200, you are going to multiply it by 10 and close. Okay, we'll go one by one. So now he has sold all the shares, this 100 and the bonus shares 100 on 1/10/2024. It means he has sold all the 200. This you had purchased on 1/12/2023. You have sold it before 12 months. So this is going to result in what? So this is going to result in short-term capital gain. And this is going to result in long-term capital gain. Understood the difference? Very well. Now let's discuss about the bonus shares. See, bonus shares, if it is acquired, if the bonus shares is allotted on or after 1/4/2001, then the cost of acquisition would be nil. If it is before, you would take the fair market value as on 1/4/2001 as your bonus shares value. This is allotted after, yeah. So it is going to be cost of acquisition would be nil in case of this bonus shares. Very well. Cost of acquisition would be nil for bonus shares. And this is short-term capital gain, and dividend, though we have seen, this will go under the head income from other sources. Clear? Great. Done. Now, He has sold all the shares. Now it is resulting in short term and long term. How do you determine a capital gain as long term or short term? Is that it is based on the capital asset. If the capital asset is long term, you will get long term capital gain. If the capital asset is a short term, you will get short term capital gain. Clear? No. He has sold all the shares on 1/10/2024 at the rate of 4,000 per share to a recognized stock exchange. What is it? At the rate of how much? 4,000 per share. What do I mean by at the rate of 4,000 per share? Sale price, sale consideration is 4,000 for this total of 200 shares. Okay. Now, he has paid brokerage of 1%. However, it is allowed as expenses. Sorry, people, remember, STT is not allowed as expenses. Govinda, no. STT is not allowed as expenses under your capital gain. It is allowed as expenses under your PGBP provided you are doing the business of this shares trading. Understanding? STT is not allowed as expenses. Don't take this deduction in your capital gain. Brokerage is allowed. Brokerage you can take. Okay. Now let's do the total income computation and the tax liability point over here. Okay. Let's go one by one. See, basically, if I'm speaking about this long-term capital gain, all of us know which section will be applicable. Tell me, under section 112A. 112A will be applicable, no? If 112A is applicable, all of us know how to determine the tax liability for this one. Tax liability under section 112A, if the sale has happened on or after what date? 23/7/2024. If the sale has happened on or after 23/7/2024, then it is going to be treated as your long term. Sorry, then it is going to be taxable at the rate of 20%. If it is below that, the taxability, long-term capital gain, long-term capital gain under section 112A, if you had sold or if the sales has happened on or after 23/7/2024, then the tax rate that would be applicable would be 12.5% and the exceeding how much? Exceeding 1,25,000. If it is before 23/7/2024, then the tax rate that would be applicable, the long-term capital gain tax rate that would be applicable will be 10% on exceeding 1,25,000. That limit of 1,25,000, whatever I told, it is for the entire year. It is not for the one particular period. Clear? No. So sale consideration, all of us know 100 shares were there. I told you, multiplied by this. See, 100 shares sale consideration, sir. 4,000 rupees per share. 100 plus 100, 200 shares. But in this case, it is long term. Now, first we are calculating long term capital gain. So it has to be 100. So total is 4 lakh. Brokerage you have taken based on the sale consideration. So 4,000. Where even net sale consideration is 3,96,000. You had no problem till here. Next, the cost of acquisition, which I would consider, how do you consider the cost of acquisition over here would be higher of the following people. If you remember the cost of acquisition calculation, it will be the higher of actual cost of acquisition or the lower of following these two. Whichever is lower, the answer would be qualified into the second point. Whichever is higher would be your final answer. Everyone? Actual cost of acquisition, I told you, whatever is the money which moved out of your pocket will be your actual cost of acquisition. Now I would consider whichever is lower of the following. That is the fair market value as on 31/1/2018, actual sale consideration, whichever is lower. Why would I take that? There's a story behind that. See people, what happened was, on or before this date, that is 31/1/2018, long-term capital gain which you were receiving, if you would have sold your long-term, that is if you would have sold your shares on or before this date, exactly on this date or before this date, the long-term capital gain was nil. That is, the taxability on the long-term capital gain would be 0. Later on, what they told in the budget which they bought on 1/2/2018, they told now long-term capital gain will be taxable. The people started crying. They are like, if I would have known about it, I would have sold in the previous day only. Why would I make it to wait till the government come with the provisions of to make it taxable? Now the department told her, don't cry. I am not yet completed. See, whatever is the price which fair market value as on 31/1/2018, can I say, if you would have sold your asset, that is your whatever shares, long-term capital gain, no, long-term capital asset shares, you would have sold on the fair market value as on this date. No? So till this point of time, till particular value of that fair value, whatever the fair market value which you have, till that amount, I'm not going to make it as taxable to you. Till that amount, I'm not going to make it as what? Taxable. See, let's take a simple example. Suppose if the fair market value is, suppose just an example, random example, okay? For you to make the concept to be understood. The fair market value as on 31/1/2018 is, let's consider 10. Okay, the actual sale consideration is 18. Your actual say cost of acquisition is 8, suppose. What would be your actual cost of acquisition? Let's consider the sale consideration is 18. I've already determined this sale consideration to be 18. No? So let's look into it. Sale consideration is 18. Now I have to determine cost in order to understand my capital gain. Correct? What is my long term or what is my capital gain for that matter? Normally speaking, what you would do, you would directly take the cost of acquisition. I will do as per this process. Then later on you will understand the reason. See, 8, first of all, 10 or 18, whichever is lower. So what would I record? I would record 10. 10 or 8, whichever is higher. How much would I record? 8. Great. The total is 10. Long-term capital gain would be 10. Hold on. Suppose, let me change your example little bit. Suppose the fair market value is 10 and the actual sale consideration was only 9. Okay. My actual sale consideration is how much? 9. Now, can I say, you have sold today at 9. But if you would have sold it on 31/1/2018, you would have sold it at 10. You would have sold it at what price? 10. So can I say that till that 10, I would have normally wouldn't pay any tax on that amount which I would have got to that extent of 10. If my sale consideration was 10, I wouldn't have paid anything because it was equal to my fair market value. Any amount, any consideration, any sales amount which you have, if it is less than the fair market value as on 31/1/2018, you wouldn't pay any capital gain tax. That is what they're stating. Understand? Sale consideration is 9. Whichever is lower would be considered. I would consider here 9. Whichever is higher, you would consider. Correct? I would consider 9. So it's 0. My capital gain which I would pay would be 0. Let's take a different multiple situation or multiple scenario. Suppose my fair market value is 10 and my actual sale, let's consider my fair market value was 7. Okay. Now tell me whichever is lower would be considered for the higher option. That is, I would consider 7. Here I would consider whichever is higher. My actual sale consideration is 9. For the purpose of cost of acquisition, whichever is lower, I would consider that is nothing but 7. 7 or 8, whichever is higher, I would consider 8. So I would pay long-term capital gain as well. So in my earlier example, can I say, if your fair market value, to whatever extent is your fair market value is, you will never pay tax or you will never get the capital gain to that extent of fair market value as in 31/1/2018, because till that amount you wouldn't pay tax if you would have sold it on 31/1/2018. No. Now also the department is like, till that amount, if that amount is equal to sale consideration, you will not get it. If your actual sale consideration is less than the fair market value, also will not get it. If your actual sale consideration is more than the fair market value, then we'll make a further comparison with your actual cost of acquisition. Then we will make it as taxable. I hope it is clear. Okay. I hope it is clear. Now, so this, out of doing all this calculation, whichever is lower, I would consider that is 2 lakh. Whichever is higher, I would consider that is 2 lakh. I would consider the same amount, 3,96,000. So my long-term capital gain would be 1,96,000 based on the math. I told you, all of us know that the bonus shares, whenever they're issued, the capital cost of acquisition is 0. The sale consideration, 100 shares I got, 4,000 is the rupees. Sale consideration I have. Brokerage. Brokerage 1% I have recorded. Net sale consideration I have. Cost of acquisition I have subtracted. There is nothing to subtract in the cost of acquisition. So what I would do, I would record the short-term capital gain as 3,96,000, whatever the answer. Income from other sources I already explained. 200 shares, 100 plus 100. 100 original and 100 is your the other one, that is your bonus shares, multiplied by 10, 2000. Jai. Other income you have in the question 8 lakh. The total income is 30,94,000. All of us know when we are doing the tax liability calculation, remember the tax liability, first of all, when you're doing the tax liability computation, first you have to give the segregation of your long-term capital gain and short-term capital gain, because these comes under the special rates of tax. Correct? As these are coming under the special rates of tax, first what will I do? I will take out long-term capital gain. However, up to 1,25,000 rupees, there is no taxability coming in. So only the difference amount will be subject to tax under section 112A at 12.5%. Why 12.5%? Look in the question. It has been sold on 1/10/2024, which means it is on or after 23/7/2024. Hence, I am taking 12.5%. If it was before that date, I would have taken 10%. Clear? 12.5% into 71,000, that is 8,870. Short-term capital gain under section 111A, which speaks about 3,96,000. Govinda, 3,96,000 over there into 20%. Why 20%? Again, under section 111A, there is a changes in the amendment that has happened. There is amendment that has happened, and it has been specified. If the short-term capital asset under section 112A, 111A, which has been sold on or after 23/7/2024, then the tax rate would be 20%. If it is before, it is 15%. Hence, we have taken the 20%. Clear? Tax on remaining income. See, how did you get this remaining income? This is your total income. Out of that, for this extent, you have already considered the taxability. Remaining 8,02,000, you are paying under default tax regime. Default tax regime. Default tax regime. You are paying it under default tax regime. So it is going to be up to 3 lakh and so much amount. I assume you already know the tax liability computation. So I am not doing it again. Okay. Up to 3 lakh nil, 3 lakh to 7,20,000. Okay, chalo, I'll only do it. How much is the difference, people? 4 lakh is the difference. 4 lakh into, how much is the percentage? 5%. For 4 lakh into 5%, how did you get this 4 lakh? 7 lakh minus 3 lakh. The difference between this is 4 lakh. Clear? Similarly, you will do for the next one also. For that, you have got 10,200 as the total tax liability. 30,200 is the total tax liability. You have already calculated the tax liability for this separately. Remaining income separately. You have this as your total income is less than 50 lakh. There's no surcharge applicability. HEC will be 4% and the total income will be 1,23,006. Clear? This is your. Now let's move forward to this question number 2. That is the concept behind this. Wait, let me do one thing. Let me go through the material for you people for 112 and 111. Okay. See, under section 111A, 23/7/2000, if it is purchased, if it is transferred before this date, 15%, after 20%. 111A was it? 112A, in case of 112A, if it is before 23/7/2024, 10% on LTCG, on or after 12.5% on LTCG. However, the total exemptions cannot exceed total. The total for the entire year, it cannot exceed 1,25,000 people. It's not 1,25,000 before this date and after this date. Total 2,50,000. No, it's not like that. 1,25,000 is for the one entire year. Okay. So this is 112A. So now before getting into the next question, let me cover that respective concept so that it will be easier for you to understand that. Okay. The concept is the conversion or the treatment of the capital asset as stock in trade. Okay. As stock in trade. Try to understand this example, you will understand the concept. See here, let's assume you have a property which has been there with you. You have a 1 acre of property. Okay. You have 1 acre of property. Let's consider. Rich people you guys are having 1 acre of property. Okay. This property was purchased by you in some year. That is, you have purchased this property in certain period. That is, let's consider when this capital asset was purchased by you. Let's consider you had purchased this in 1415 PY. Okay. 1415 PY only you have purchased this capital asset, and the cost of this capital asset was 60 lakhs. Suppose. Okay. Okay. So the cost of this capital asset was how much? 60 lakh rupees. After some years, you saw the development in that area and you understood the capital asset of 1 acre of land which I have. Now, if I sell it, if I convert it and if I sell it, I will be able to get what? I will be able to get some more income. That is, I can convert it into 60-40 or 30-40 plots over here, and then I can sell it. Now we are thinking, okay, if I sell it, I'll be able to get some more income. But what about the taxability? Because see here, PY 1415, what has happened? You have bought a capital asset, correct? Good fellow, you have bought it. In the PY 22, let's consider 22-23 PY, okay? 22-23 PY, what you're doing is that you are making a conversion. What are you doing? You are making a conversion. Conversion of property. That is conversion. Capital asset into plots. Plots is nothing but your PGBP. PGBP, you are converting your capital asset into your inventory on what, in which year? 22-23. Okay. And you have sold that plots. In which period? You have sold that plot in the period PY 24-25. Array, that is why it is coming into your exam. No, 24-25, you have sold it. Very well, fine. Now, comes the question, I was holding it as a capital asset till this time, and now it has been sold as a plot. What is the taxability? Very simple. From this period to this period, you treat the asset as capital asset, and from this period to this period, you treat whatever the income which you get as your PGBP. How to make the differentiation is very simple. Try to understand. See, this is done capital asset, this is done PGBP. Okay. Now, if I'm speaking about the capital asset taxability first, tell me, if you wouldn't do that conversion in PY 22-23, 100% you would have sold the capital asset as capital asset only, correct? If you wouldn't have done the conversion, you would have sold the capital asset as capital asset. At what price you would have sold? You would have sold at the fair market value or as on the date of conversion in PY 22-23, correct? You would have sold at that fair market value only, no, as capital asset. What else you would have sold it at? Making sense? Let's consider the fair market value as on this date is 2 crore. Okay. When you sold that property for PY 24-25, the total sales that you have got is 3 crore 20 lakh. You have got 3.2 crores. Okay. 3.2 crores is what you have got from selling the plot. Fair market value is so much, and the cost which was involved in purchase is 60 lakh. These are the necessary information. Now think, if there was no conversion. Suppose if there was no conversion, what you would have done, how you would have calculated the capital gain. I'm ignoring the indexation part here for simplicity purpose. How you would have done the calculation here? You would have taken the fair market value. Obviously, this would have been your sale consideration. No, everyone, this would have been your sale consideration. Your sale consideration would be your fair market value as on the date of conversion. Correct? Okay. What is the price at which you would have sold? What's the price at which you would have sold? You would have sold it at 2 crores. Very well. Okay. Minus what would have been your cost of acquisition? You already have the cost of acquisition. I'm ignoring the indexation part for simplicity purpose. It is going to be how much? 60 lakh. What is the capital gain for which you would have paid the tax for 1.4 crores? You would have paid that. It would be your long-term capital gain 1.4 crore. Clear? This is what you would have done in case of if it was your capital gain. Correct? Now what's happening? Now the problem is you have considered it as capital gain. Fine. But now you've already converted it into PGBP. No, you have to give the effect of PGBP here. Tell me, how do you compute the profit in PGBP? Sales minus cost. Simple concept. That is what I will be doing here. What is the sale price? Everyone, what is the sale price in this question? 3.2. Correct? 3.2 crores. This is not like this is 3.2 crores. Correct? Array, for me, that final amount which I got is 3.2 crore. Out of what did I get that 3.2 crores from? From that property, no? Array, think people, this capital gain and the taxability PGBP, it's being taxed on one property only. It's being taxed on one transaction only. You can't put capital gain on the entire transaction, PGBP on the entire transaction. The transaction taxability has to be splitted in between these two so that the taxability is proper. Correct? Now, can I say for this total worth that you have got 3.2 crore, array, up till 2 crore, till this fair market value as on the date of conversion, you've already considered it to be your capital gain. Out of this 3.2, 2 is already considered. Array, 3.2 you got for this entire property, no? Till this period, you've already considered it to be your capital gain. Again, why are you going to make it as taxable here? So what will I do is that I will remove the effect of, that is the cost in this case, will be nothing but my fair market value as on the date of conversion. You have already considered here. Understanding why I took 2 crores minus over here. Because I've already considered as taxing under capital gain separately. Now I am removing that effect so that I will tax it only under my capital. Tax it only under my PGBP. So PGBP, it will be taxable at the rate of 1.2 crores. Capital gain, it will be taxable at the rate of 1.4 crores. At the amount of 1.4. See people, very simple. If you want to make it a quick summary, 3.2 crores is the total price. Out of this 3.2 crores, I have already considered my 2 crores as my fair market value as on the date of conversion as my capital gain. Correct? Understanding? Already considered 2 crores separately. And remaining this difference of this 2 crore and this one, 1.2 crores is considered as my PGBP separately. Correct? To be much more simpler, directly take what is your cost, what is your total income that you got here, 2.2, 3.2. What is your actual cost here? Remove this capital gain, everything. Just think. What is your cost here? 60 lakhs. So total should be how much? Total should be 2.6 crores. No. Your total taxability of your income should be 2.6. Out of this 2.6 people, if you can observe, 1.4 is being taxed as PGP, a long-term capital gain, and remaining 1.2 crores is being taxed as your PGBP. Here only finished. No, what more confusions you can have here? No confusions at all. Out of 60, 1.4 is long term and 1.2 is short term. It's already 2.6. So your entire income is taxable Out of your entire income, reducing your cost, your entire 2.6 is taxable, but it is splitted as capital gain and PGBP. That's it. Done. I hope it is clear. Keeping this point in mind, let's look into the next question. This is a very simple question. Okay. Aarav converts his plot of land purchased in July 2004 for 80,000 into stock in trade on 31st March 2024. The fair market value as on 31/3/2024 was 3 lakh. Okay, the fair market value as on the date of conversion they have given. Stock in trade was 3,25,000 in the month of January. Sold. So find out the taxable income under the head, and this is for the assessment year 25-26. The indexation, for the purpose of calculating indexation, they have given you the rates. See here, simple, simple, simple. Very, very simple concept. You already have sale price. In case of your PGBP, it is very simple. You have your sale price. First, let's go with the capital gain only for clear understanding. How much is the fair market value as on the date of conversion? 3 lakh. If I would have sold, I would have sold it at 3 lakh only. 3 lakh. What is my cost of acquisition? 80,000. I should do the indexation. Why should I do the indexation? When was this property being sold? Even though it was sold in the month of January 2025, let's do the computation considering this fellow is opting for option 1. I will explain that point of option 1 and option 2 later. Just right now understand indexation concept is applicable for this fellow, and let's do the solution. That other option 1, option 2, I'll explain it in later part. Okay. See, indexed cost of acquisition is 80,000. When was this sold? This was sold in which date? When was this purchased? It was purchased in July 2004. So, in the period July 2004, the indexation was how much? 103. So, date of cost or date of purchase, we are going to put it in denominator. Numerator would be how much? 348. And if you do this indexation, you would get 2,46,372. 2,46,372 is what I would consider in this case. If you subtract so much from so much, you will get long-term capital gain. So what is the sale price? Sale price is 3,25,000. You have already considered this amount over here. This is what I would take because you've already considered it under capital gain. I will subtract this. And my PGBP would be 25,000. So if I consider my total income, how much would be my total income? Total of these two would be 78,628. I hope it is clear. Okay. The next question, that is Mrs.Harshitha. This question is a very, very good question. So we will do this question correspondingly. Okay. Mrs.Harshitha, she purchased a land at a cost of how much? 35 lakhs in the financial year 4 and 5. Mrs.Harshitha purchased a land at a cost of 35 lakh in the financial year 2004-5 and held the same as capital asset till 20th March 2024. Very well. Till 23-24 PY, till PY 23-24, she held it as capital asset. She started a real estate business on 21 and converted the said land in, that is land in stock, and on the same date, that is on 21st March, when the fair market value was 210, she converted, that is till 20th March, she had held it as capital asset, correct? Post that is in PY 23-24, she converted her capital asset into stock in trade. So the date of conversion, the fair market value becomes important in this case, 210 lakh. Okay. Right from 4-5, see, try to understand the timeline over here. 2004 and 5, she purchased the capital asset, correct? In the PY 23-24, she converted it into capital asset. And let's see what she has done moving forward. She constructed 15 flats of equal size, quality and dimension. Cost of each flat 10 lakh. Construction was completed in February 25. February 25, she sold 10 flats at 30 per flat in March 25. The remaining 5 flats were held in stock as on 31st March 2025. See, she sold how many flats? 10 flats at 30 lakh per flat. Correct. It means she had total constructed 15 lakh. Out of that, only 10 flats have been sold. That is, out of total 15, if 10 has been sold, can I say 2/3 of the capital asset has been sold? See here, 2/3 of the capital asset is only sold, not the entire capital. Entire capital asset is not sold. So, what computation we would be doing? We would be doing the capital gain, every calculations of the capital gain, keeping 2/3 as a proportion. Because only to that extent of sales, we have to show it as a capital gain. Correct? Because this is coming under a point under the provision of section 45, wherein it states it will be taxable in the year, not in the year of transfer, but in the year of receipt. You converting the capital asset and you selling it, you get the money, only then it will be taxable under the capital gain. That is what it means. Okay, very well. She sold 10 out of 30, and this sale, as for the PGBP sale price, 30 lakh rupees per flat and 10 flats, this would lead to how much? This would lead to 3 crores. Okay, the remaining 5 flats were held in stock. Fine. She invested 50 lakh in bonds issued by NHAI and on 31st March 2025, and another 50 lakh in RECL. People, if you remember section 54 EC, it states the individual can go and invest in NHI and RECL bonds or the government bonds, where the minimum period of redemption, minimum period of holding should be 5 years. You can go and invest here. Whatever amount you have capital gain, whatever the amount you have invested, you will get the exemption. But the maximum limit should be up to how much? 50 lakh rupees. And also it should be purchased within 6 months from the date of transfer. See, when has the transfer happened? That is basically the transfer has happened on what date? On basically on 30th, 31st of basically the year of sales that has happened in 24-25. So let's see what we will do in under section 44 for 54 EC. The maximum you can take is only 50 lakh over year. Okay. Compute the income chargeable under the capital gain and the business income and Mrs.Harshitha arising about the above transaction for EY 25-26, and cost inflation amount is also given in the question. Okay, very well. See now, first of all, when I'm calculating the capital gain over a year, this is the full value of consideration. That is the fair market value as on the date of conversion. How much is it? First of all, how much is 210. The complete amount is given here. I'm taking completely 100%. Okay. First, you can do in two ways, people. First, I will teach you in this way, and then I'll tell you what is the other way. First, try to understand whatever I'm telling. Take the full amount. Don't do 2/3 proportion. Take the full amount. Okay. How much is the cost of acquisition for you? 35 lakh. So 35 lakh divided by which is the year of purchase. What is the cost inflation index over here? 113. Which is the year of transfer. Remember, the year of transfer would be the year of conversion. No, for you to calculate indexation, please remember 23-24. So 348 is the indexation for 23-24. You have taken, say, you'll do the computation, you have got so much. What is the capital gain that you have got in total? This is for 100% of your capital asset. But we need only for 2/3 of the capital asset. No, that is 10 and 15. If you bring it down, it will become 2/3. So the entire amount you can bring it to 2/3, and then you will get the capital gain of so much. However, suppose you would have considered this, that is the year of transfer is so much, and you have considered, you could have done another thing, that is 210 lakh whatever you have, you could have taken 2/3 year directly and you would have recorded here. Similarly, this multiplied by 2/3 if you would have given, you would have considered here. And the total answer you would have got the same here. You would have got 68, 14, 159 only. You would have got the same answer. No difference at all. Done. And the capital exemption under section 54 EC, I told you, within 6 months from the date of transfer, you would have recorded. From 6 months from the date of sales year, when is that sales happened? She had sold the flat in March 25. And in March 2025, in the same month, she has invested in the rural, in the NHI and in RECL. However, only up to 50 lakh is available. No, under section 54 EC, I will provide only 50 lakh. And after After this, the taxable capital gain for AY 25-26 would be so much, 18,14,159. In case of business sale, 10 flats multiplied by 30 lakh rupees per flat will be 3 crore. Whatever is the amount which you have already considered as taxability of capital gain will become your expenses. That is, will become your cost for the flats. And additional 10 lakh would be incurred for how many flats? 10 flats, no. So 10 lakh. So 1 crore. Remember, 210 is for 100% of the property. We are doing it for 2 by 3rd. In the question, if they would have mentioned, suppose 15 flats are constructed and entire 15 flats are sold. Govinda, we wouldn't have done all these things. 10 by 15 and all, we wouldn't have done. We would have taken it directly. Okay. 10 into 10 lakh, so much. Business income for AY 25-26 would be 60 lakh. Understood? I hope it is understood. Okay. See, this question number 4, that is Mr. A is an individual carrying on his business for that matter. This is the theory oriented question, people. You please read this question by yourself. So we will move forward to some important topics. First, we will do this question number 7 because this combines all the provisions, all the necessary important provisions which is required. And then later on we can do the question number 5 and 6 easily because this is the full masala question. Okay. Mr. Shiva purchased a house property on February 15th, 1979 for 3,24,000. This is the purchase value. In addition, is also paid the stamp duty value for 3,50,000. He has also paid stamp duty of 10% on the stamp duty value. So how much would be his actual cost? See, cost means whatever money which moved out of my pocket, correct? Whatever is the money which moved out of my pocket, I would consider the same. In this case, my stamp duty value is 3,50,000. Of that 3,50,000 I paid, 10% means 3,50,000 into 10% is going to be how much? 35,000. And Shiva purchased a house property on February 15, 1979 for how much? 3,24,000. This also I paid out of my pocket, that is 35,000. 3,24,000 I paid out of my pocket. So my total cost would be how much here? Calculate. 3,24,000 plus 35,000. How much would be? It would be 3,59,000 would be my actual cost of my acquisition. Clear? In April 2008, Mr. Shiva entered into an agreement with Mr. Mohan for sale of such property for 14,35,000. Received an amount of advance so much, okay. Sale consideration did not materialize. Mr. Shiva forfeited in advance. Think under section 51. You guys remember section 51? People, if the advance is forfeited, if it is forfeited on or before 1/4/2014, if it is forfeited before 1/4/2014, not on, before 1/4/2014, whatever the forfeiture that has happened, you would reduce whatever the advance money which you have received. That would be reduced from the cost of acquisition. In the other case, if it is after, you would add it, record it under income from other sources. You would record it under income from other sources. Let's look into the provision here. See, whenever the advance money which has been received, okay, what is it? Whenever the advance money which has been received, and if it is forfeited before 1/4/2014, if it is going to be adjusted from the cost of acquisition from your total computation. See, before what happened, before this date, story before this date, the department told, Arey, you're thinking of selling a property. Okay. That one fellow came, he told that, hey, I will buy the property, 2 lakh rupees, take this advance. He threw it on your face and he went. After some days, you called him. He is telling that I will not buy the property. You are telling him I will not give the advance. He said okay. And that advance money which you have received and it is forfeited. If it would have been sales, you would have recorded it as capital gains. Correct? It is not your sales. Your property has not been sold. That fellow fought with you and he told 2 lakh rupees you only keep. Forfeiture has happened. That is, you are telling, he is telling whatever, 2 lakh rupees you have in your hand. The 2 lakh rupees as per the income tax, if it is happened before 1/4/2014, you should subtract it from your cost of acquisition. For this property, let's consider you have paid your hard-earned money of 8 lakh. That fellow gave you 2 lakh rupees as the advance. Okay, he told that I would buy the property, take this 2 lakh as advance. Now, whatever the advance which you have received and forfeited, that would be subtracted from my cost of acquisition. Same situation, copy paste, you think in that has happened after 1/4/2014. That is, that has happened on 2017 or 18. You have the property of worth 8 lakh, cost of acquisition, and this fellow 2 lakh rupees. To that extent, this fellow is telling that I don't want any property of yours. Now what you're doing is that this 2 lakh rupees, you're not adjusting it with your cost of acquisition. 2 lakh rupees, you're showing it as your income from other sources, and you will show in that year in which that forfeiture has happened. In my example, it was in PY 1718. No, in my PY example, it was in PY 1718 and it is closed. You are not going to consider this. Understanding? Clear? Comfortable? In PY 1718, you are going to understand this. Done? Now, identify or understand the same point here. This fellow entered in 2008. It means it is before 1/4/2014. Advance received is 1,11,000. Sale did not happen and the advance was forfeited. So what you would do? 1,11,000 rupees you would have subtracted from your cost of acquisition. Correct? This has happened before. So you would have reduced it from your cost of acquisition. What was your cost of acquisition? 3,59,000. 1,11,000 rupees you would have subtracted. Correct? In May 2015, he again entered into an agreement for the said house for 20 lakh with Deepshika and received 1,51,000, and she did not pay the balance amount. It was forfeited. Tell me, if it is forfeited after 1/4/2014, would you reduce it from your cost of acquisition? No, you would not reduce it from your cost of acquisition. You would have shown it under income from other sources. Clear? Mr. Shiva constructed the first floor by incurring a cost of 3,90,000. What is it? This fellow constructed the first floor by incurring a cost of how much? 3,90,000. So this is going to be a cost of improvement. We'll look into it, the indexation part later. Cost of improvement is allowed as your deduction in your computation, and you can do the indexation. If it is provision of that indexation, I'll be explaining it very soon. Okay. On 15 May 2024, again he entered into the agreement with Mr. Manish for sale 30,50,000. Sale, the property value is how much? 30,50,000 sale consideration. Received an amount of 1,50,000 as advance through account payee check. Remember this concept of recording the stamp duty value and all, it is coming under section 43CA. Okay. 43CA is detailedly explained in a separate video. You can go and watch that video if you want a clarity with regarding to section 43CA. Okay. Now, 30,50,000 and received an amount of 1,50,000 as advance to account paycheck. Mr. Manish paid the entire balance of Mr. Shiva, transferred the house to Mr. Manish in February on this date, and he paid the brokerage of 1%. Very well. Fair market value as on this date is 11,85,000. Stamp duty value was 10,70,000. Further, the valuation of this property on 15th November is 39 lakh and the 20th February was 41 lakh. Compute the capital gain in the hands of Mr. Shiva for EY 25-26. Also compute the tax liability under section 112, assuming that the basic exemption limit has exhausted. CII for that respective year is given. Okay. See, this point of section 43CA, I will give you a quick understanding of that section. See, this is a very, very good section and very logical also, the section 43CA. 43CA section is for your PGBP. Section 50C is the copy paste of that section 43CA over here. Okay, it's a copy paste section basically. So now section 50C speaks about if you're transferring any land, building or both. Only applicable for land, building or both. Okay. If you're transferring any land, building or both over here, and that whatever transfer of that asset you are doing, what is the full value of consideration you will be doing? No, in sale consideration minus cost of acquisition and all, you would be doing all this work. What is this sale consideration? What is the full value of consideration would be the question. Okay, what would be the full value of consideration? That is what we are studying in section 50C. We are looking into this part here. Okay, now see, try to understand a point. Now you have purchased a property. Let's consider you have purchased some property. Okay, and that property value is suppose you are buying or selling. Let's consider, let's speak in the sales terms. You are selling a property. Sale consideration for you is 1 crore. Now you both have decided, and you and me both have decided that we are going to sell the property and we are going to buy the property 1 crore. Okay. As on the date of sale, the stamp duty value was 1.5 crores. That is 1 crore 5 lakh it was. Okay. You are telling that stamp duty value is nothing but the market value which the government has. SDV is how much? 1.5 crores. You are telling that okay, 1 crore rupees you give sale consideration. I want 1 crore rupees as my sale consideration. Department. Now the department is coming and asking for the taxability. You are telling that, array, what is there in the taxability over here? 1 crore is my sale consideration. I'll show 1 crore only. But the department and the government is like, wait. You wait. No, we have certain clarifications to be given to you. What is that? If your STV, what is? If your STV is up to 110% of the consideration, sale consideration of whatever you are recording. What is your SDV here? SDV is 1.05 crores. Is up to 110% of the consideration means what is your consideration? Your consideration is 1 crore. 110% of your sale consideration means 1.1 crore. 1 crore 10 lakh. Up to means less than or equal to. So it is less than. If it is the case, then your full value of consideration for this purpose, whatever I told you, sale consideration minus cost of acquisition you would be doing, no. The sale consideration, the full value of consideration for this purpose would be your actual sale consideration only. You would take 1 crore only as the point. Suppose if your STV is greater than 110% of the sale consideration, then your full value of consideration would be not your actual sale consideration here, it would be your SDV only. Think logically. The money which is coming out of your pocket, the money which is coming into your bank account is 1 crore. But still the department is like, no, we will treat it as SDV only. When is that case? When the SDV, let's consider another example. SDV is 1.15 crores. Okay. Your SDV is 1.15 crores now. Obviously, it is more than 1.1 crore here. So now consider 1.15 crores as my consideration for the purpose of taxability. Tax calculation you consider. Think here. Money which came to your bank account is 1 crore only. But for the purpose of taxability, you are showing 1.15 crores. Clear? Now you are sitting and crying. Why? Array ma'am, first of all, what happened? My date of agreement and my date of registration was different. Now I am coming up with 2 SDVs. How many SDVs I have? I have 2 SDVs because my date of agreement and date of registrations are different. Let's consider my date of agreement was 1/1/2023 and my date of registration is 1/1/2024. Okay. Because of the difference, the value has been increased. STV as on this date was 1.5 crores and STV as on this date is 1.15 crores. All of us know land value keeps on getting appreciated. So assuming that it is increased, I am keeping it as 1.15 crores. Now I have 2 different SDVs, ma'am. Now what to do? The department is like, okay, fine. If you have paid, see, when at the date of agreement, obviously you would have paid some advance, no? You would have paid some advance token money, we call it as in general sense, in general language. Advance you would have paid. Let's consider you have paid some 2 lakh rupees advance. You can either pay it in cash or through banking channels. Banking channels include account pay check, account pay draft, or any other electronic modes, that is RTGS, NEFT, debit card, credit card, anything it includes. Banking channels. Okay. Suppose you would have paid it in cash, physical cash you would have paid. Then the department is like, Array, first of all, we are trying so much to reduce the cash transactions. You are going and paying it in cash only. You take the SDV on the date of registration. If you take the registration, SDV as on the date of registration, all of us know it is more than 110%. You should pay tax on 115. Suppose you like a good fellow, you have taken it in banking channels. The date of agreement, you have taken the advance in account pay check or RTGS or NEFT. Now you can take the SDV as on the date of agreement, that is 1.5 crores, and now your actual sale consideration will be 1 crore. Why is this partiality coming in? Very simple. The government wants to reduce the cash. The department wants to reduce the cash transaction. You have followed it like a good fellow. Take the date of agreement only. Generally, it will be less than date of registration. If not, take the date of registration for that point. So this example which I told, this will be helpful in the question which we would be solving. Okay. See, try to understand the same, apply the similar point here. Mr. Manish, sale consideration is how much? Your actual sale consideration. Your actual sale consideration is how much? 30,50,000. Received an amount 1,50,000 is advance through account pay check. Now, let's wait. He entered into an agreement on this date. He entered into an agreement on this date and paid the entire balance and transferred the house, and the date of registration was on this date. Date of agreement, date of registrations are two different dates. Now let's see, is there any SDV given? Yes, SDV as on 1/15th is 39 lakh, and SDV as on this date, just a minute. This is going to be the SDV as on the date of registration. This is the SDV as on date of agreement. Correct? This is the SDV as on date of registration, date of agreement. Two different SDVs. When it is two different SDVs, which SDV would you take for the purpose of consideration? Would be if the advance is paid through banking channels, account pay draft, account pay draft, check, account pay check, any other electronic clearance mode, you would take the SDV as on the date of agreement. So 39 lakh you would take for the purpose of comparison. Now see what happens. How much is my actual sale consideration? 30,50,000. How much is my SDV? 39 lakh. I should see what is my 110% of the consideration. 30,50,000 into 110% would be 33,55,000. No, which is obviously SDV is greater than your 110% of the consideration. So what would be your actual sale consideration? Your SDV would be your actual sale consideration. Correct? Your SDV would be your actual sale consideration. See, as your SDV is more than 110% of the consideration, 30 lakh and 30,50,000, 39 lakh, 110% of that would be how much? 33,55,000. In this case, 45 is written. 30 lakh, 33,55,000, 39 lakh would be done. Clear? As it is paid in the account advance check, we are going to consider the SDV at the date of agreement. Okay. Now, you have some expenses which has been recorded 1% of sale consideration. Correct? How much is the brokerage? 1%. 1% on 39 lakh. No, people, please, this is 1% of sale consideration. Sale consideration money which is coming in your pocket is 30,50,000 only. That is what you are recording here. 30,500. Okay, 30,500. Your net sale consideration would be, after subtracting this from this, your net sale consideration would be so much. Now, determining the actual cost of acquisition. People, there is a small provision which I need to explain over here. Whenever you're determining the cost of acquisition, when was this property purchased? Before 1/4/2001. If you have the cost of acquisition, if you have the property which was purchased prior to before 1/4/2001, you would consider your actual sale of actual cost of acquisition or your fair market value as on the date of consideration, whichever is optional, beneficial for you. But that is subject to the SDV as on this date. Again, it is subject to SDV as on this particular date. See here. See, if the property is purchased before, if the property is purchased before 1/4/2001, then the cost of acquisition will be actual cost of acquisition of fair market as on this date. But as this is in the case of land, building or both, first you have to see, compare this fair market value with the SDV. You have to take whichever is lower here. That lower will be compared with the answer of cost of acquisition. Fair market value as on 1/4/2001 or the stamp duty value as on 1/4/2001, whichever is lower. That answer you will compare with your actual cost of acquisition. Clear? See, that is what we are doing here. Your cost of acquisition, how you are determining? First, I am looking into the SDV as on 1/4/2001. Given in the question is 10,70,000. Where is it given? It is given in the question. See, where is it? SDV as on this date, as on 1/4/2001, is going to be 10,70,000. Correct? And we have the fair market value given in the question, 11,85,000. Correct? 11,85,000 given in the question. Out of these two, whichever is lower is 10,70,000. But you have actual cost of acquisition, no? 3,59,000. We already know how we got this. That is, out of this 10% you have paid, so the total is 3,59,000. Out of this, whichever is beneficial for you, you are going to. Everyone, sorry, out of this, whichever is higher, the cost of acquisition would be whichever is higher. Everyone, understanding? I hope it is clear. Now, so 10,70,000, the cost of acquisition, whichever is higher would be considered. So out of this, whichever is higher you would take. Why would you take whichever is higher, people? Because higher the cost, lower the capital gain, income which you would get. So you would take 10,70,000, you would take 10,70,000. And we have already seen this Mr. Mohan who had forfeited. We are going to subtract this 1,11,000 from the cost of acquisition. That is what we are doing. We are subtracting this, and the cost of acquisition for the purpose of indexation calculation is 9,59,000. And you have 9,59,000 which was sold year of transfer. Year of purchase was prior to that. So you would take the year of transfer at CII or 2001 and 2, whichever is later. So you have got the index cost of acquisition. Index cost of improvement also 3,90,000 given in the question. You would do the indexation, you would get the answer. Now, you have got the cost of acquisition here and you have got the cost of indexation here. Long-term capital gain, so you have got. This is, sorry, you have got the, where is it? You have got the indexation here, 34,81,000, and you have got 5,57,362 long-term capital loss that you have got. Okay. So people, under section 112, when you are selling a property for that matter, land, building or both, or in that case, section 112 mentions certain points. That is, there are certain important amendments which has been come up with the section 112. Correct? Everyone? What are those amendments is that, people, amendment class or the amendment session has been completely with a detailed explanation has been posted in my YouTube channel. You can go and watch that detailed amendment session. Okay. If the transfer has taken place under section 112 before and after. If it has been taken before, what were the provisions before? 20% of indexation, other assets, all these things were there. If it has happened after, now you need to consider. Whatever you are filling in this question is the land, building or both. In this case, land, building. Is it acquired, purchased before 23/7/2024? Yes. Is it by an individual? Mr. Shiva is an individual. Yes. Now I have an option of 12.5% or 20% with indexation benefit. Now I have the option of without indexation and with indexation. Whichever is more beneficial, I'll take. Other assessees, In that case, it is going to be without indexation 12.5, and in general sales also 12.5. This option is there only for individual, that too that fellow is selling land, building or both, and that too acquisition of that property should have happened before 23/7/2024. I have two indexation point, I have two taxability point, 12.5% without indexation, 20% with indexation. Clear? Now, see, whatever the solution which we have done is 20% with indexation. That is, you have taken the indexation calculation. You have long-term capital loss. So your taxability would be, there is no tax, obvious, there is a loss. In the case of 12.5% taxability without excuse me, without indexation, then it would be this calculation, whatever you have done would be the same. Your cost of acquisition will be your actual cost of acquisition, 9,59,000 without any indexation. Your cost of improvement will be your actual cost of improvement without any indexation. Now you would get what? Long-term capital gain of 25,20,500. Clear? Whatever the answer that you got, you will get that long-term capital gain. 12.5% will be your taxability, and for that final HEC of 4% you are going to add. Your total tax liability will be 3,27,666. Okay, great. Now, whatever the notes you can see, you can find that in my Telegram channel. The link will be provided in my description. You can find that. Suppose if you are not able to find it also because of the old data not available or something, you just text me. My number will be there in the group. You just text me over Telegram. I will send you the entire documents, and thereafter you can get that all those PDFs. Okay. If you would have done Mr. Shiva question properly, doing this question number 6 and question number 5 becomes easy. Okay. Now let's do this Mrs.Yuvika. Easy question. She bought a land for 80 lakh and the registration and other expenses were 10%. And 80 lakh into 10% would be 8 lakh. So your total cost of acquisition would become 88 lakh. Okay. She constructed a residential building on the said land for 100 lakh during the financial year 2007 and 8. Okay. See, if you are watching Mrs. Yuvika question separately, first watch Mr. Shiva question. That is question number 7. Question number 7, first you watch this. If you solve this question of Mr. Yuvika and this question of Mr. Sarthak question becomes very easy. Okay, that 7, question number 7, first solve that 7, then come to 6 and 5. Okay, done. So that your timings is also saved and your analysis is also good. So she entered into an agreement for sale of the above land in the said house with Mr. Johar, not a relative. In April 2015, she entered into an agreement. Sale consideration was fixed. Mrs. Yuvika received 20 lakh as advance. Due to failure, it was not materialized, hence it was forfeited. When did the forfeiture happen? This forfeiture happened on or after 1/4/2014. So, are you going to make it as a consideration or minus from the cost of acquisition? No. You are not going to do all such things. You are going to record it as income from other sources in PY 15/16 and close. Okay. Everyone, I'm telling you again, if you're solving this Mrs. Yuvika question, first solve question number 7, Shiva question, then come to this, it becomes very easy. Okay. However, due to the failure, this is done. Yuvika again entered into an agreement on sale of this house of 810 lakh in 24. She received 80 lakh as advance. The stamp duty value was 890 lakh on this date. The sale deed and executed was 14/7/2024. That is, agreement date and sale registration dates are two different dates. And the sale deed was executed and registered on this date. And the stamp duty value as on the date of registration is 900 lakh. Mrs. Yuvika paid brokerage of 1%. Clear? Now, subsequent to sale, she made the following investment. She acquired 2 residential houses at Delhi and Chandigarh for 130 lakh and 50. Fine. At UK, one property she purchased. NHI bond she has purchased. Capital gain we have to find for 25/26. Choice of exemption must be in the matter. Most beneficial. CI is there. When did this sale actually happen? Can I say the sale actually happened on 14/7/2024? This is on or before 23/7/2024. So we have only 1.20% with indexation benefit. Section 112. Okay. So we are going to do, there is no two option answers we are going to do. We are going to do only for one. No beneficial point, only 20% with indexation. Okay. See now, she entered into an agreement on what date? For sale of house for 810. So this becomes your actual sale consideration. Done. SDV as on the date of agreement and SDV on the date of registration. Two different SDVs you have. Advance was received through RTGS. This is nothing but banking channel. So you can consider the SDV as on the date of agreement. Now compare 110% of 810. So 810 lakh into 110% if you do, you would get 891. SDV is 890. Can I say this is less than or up to 891? SDV is up to 110% of the consideration, which would mean you can consider your actual sale consideration of 810 lakh as your full value of consideration. Everyone, see it. These two you have paid through RTGS, so you would consider 810. Sorry, you would consider 800 and just a minute. Yes, you would consider 890 here. Date of registration would be, it is just a minute. This is 800 and this is 900 and this is 890. We would consider on the date of registration 890 lakh. Okay, 890 lakh or 810, it is greater than 110% of the consideration. So SDV is up to 110% of the consideration. So we would take 810 lakhs. Okay. 1% of the sale consideration, my sale consideration is so much. So I would take 8.1. Net sale consideration would be so much. And I've told you 112 as the sale has happened before 23/7/2024. Now it is going to be normal 20% with indexation only. My total cost is 88 lakh. Year of transfer, year of purchase. You would got the indexation as so much. Year of construction, 100 you have taken construction amount and then you have taken the indexation of the cost of improvement, then you would have considered long-term capital gain you have. Now, when it comes to this point is different in this question. See, she acquired two residential houses at Delhi and Chandigarh for 130 and 50 lakh respectively on this date. Fine. You can get exemption on the two properties provided your capital gain is up to 2 crore. Your capital, long-term capital gain which you're getting is more than 2 crore. That is 2 crore 47 lakh. So you can take exemption only on one property. Or you can buy 2, 3, 10 also. Exemption will be available for one. What is that exemption? Option is given to you. You take exemption of 130 or 50. Which one will you take? Yeah, obviously the higher one. No. Higher the exemption, lower the capital gain tax I need to pay. So you would take 130. Section 54 ECE. Next, acquired residential house at UK. People, in order to get exemption under section 54, you should buy the property in India, not outside India. So this is out of scope. NHI bonds you had purchased for 50 lakh and 40 lakh. Can you take both? Yes, you can take both, but only up to 50 lakh, not beyond that. So your long-term capital gain will be 67.47. Long-term capital gain chargeable to tax. Okay. And this, keeping this point in mind, Mr. Sarthak question is very simple. See, if you are solving Mr. Sarthak question here, first go and solve question number 7, Mr. Shiva question. Then solve Mr. Yumika, that is Miss Yuvika question. Then come and solve this Mr. Sarthak question so that this becomes very easy. First solve Shiva question. Go watch that Shiva question, a point, and then come back to this question. Okay. Mr. Sarthak entered into an agreement with Jaikumar to sell his property for 150. This is nothing but your actual sale consideration. The sale proceeds were given in the manner. Advance on the date of agreement was received through account pay check. This point becomes important. 60% of possession, balance of the completion. Fine. Mr. Jaikumar was handed over the possession of the property on 15/12/2024 and the registration process was completed on 14/1/2025. He paid the sale consideration on the date of agreement. Fine. Now, registration and the date of agreement are two different dates. On 16/8, agreement date is this. This is the date of agreement, SDV as on the date of agreement. And registration process was completed on this. So the date of registration would be so much. And Mr. Sarthak acquired residential house on 1/4/2001. Whatever this property they are speaking about, he had purchased it for 30 lakh prior. And after the sale proceeds, he invested the money in another residential house, one in Kanpur and one in Delhi. Fine. Compute the capital gain and let's consider what is going to be what. Done. Clear. See, this point we can clearly understand if you have done that question number 7, Shiva and Sarthak question. This question would become very easy. Your actual sale consideration is 150. Date of agreement and date of registration are two different dates. Now, the date of agreement you have got account payee check. So, you would consider for the purpose of comparison 170. What is 110% of 150? It is going to be 165. Your SDV is greater than your registration. Your SDV is greater than your actual 110% of your actual sale consideration. So now what you would do is that you would take 170 SDV as your full value of consideration. Clear? And your index the cost of acquisition would be 30 lakh into 363. All of us know the cost of acquisition is already given 30 lakh. You would do the indexation for that, and the indexation would be so much. See here, 170 and 171 500 paid through account payee check 2 lakh. So we would take the date of agreement as the SDV. This two comparison 110% if I'm taking this actual sale consideration, this SDV is greater than your 110% of the consideration, you would take 170. Clear? Actual cost of acquisition, index cost of acquisition you would take. LTCG you have exemption under section 54. See now, you purchase two properties, you can get exemption up to two properties under section 54 provided your capital gain is up to how much? 2 crores. Is it less than or equal to 2 crores? Yes. So then you can take the capital gain exemption on both the property. Yes, 55 lakh. Long-term capital gain, you have considered it to be 610 LTCG chargeable to tax. Why is this so? When was this sale happened? This happened on or after 23/7/2024. So now what we would do is that we would go for option 1 and 2. That is 20%. This is without indexation. This multiplied by 20%. Or first point will be same as it is. Cost of acquisition without any indexation is 30 lakh. We would take this and exemption is taken, LTCG is taken. This multiplied by 12.5% and this multiplied by 20%, whichever is beneficial for you, you're going to take it and do the solution. Clear? So now let's look into this illustration 9, people. Before understanding this question of illustration 9, let's look into these provisions of illustration 9, whatever is concerned, so that solution becomes easy. Now, the concept which is covered is with regarding to the depreciation. See, if you are selling a depreciable asset now, some fellow came, he asked you to sell the depreciable asset, you said okay. Always remember, depreciable asset will be always a short-term capital gain only. It will never be a long-term capital gain. It is always what? Short-term capital gain. Now, computation capital gain in case of depreciable asset, how you are going to do? Very, very simple. See, whenever you have a block of asset over there, normally speaking, in your capital gain, what you would do, normally speaking, in your PGBP, what you would do, if you have, not in PGBP, in your books of accounts. In your books of accounts, what you would do generally is that, if your WDV as per the books, as per your company's act, as per your books of accounts is 100, and you have sold it for 120, you would recognize 20 as the profit on sale of asset, correct? Similarly, if it is 100 and if you would have sold it at 80, you would have recognized the 20 as loss in your books of accounts. That is what you would have done generally in your books. But in your income tax, whenever you are selling a depreciable asset, you will never recognize profit or loss in your PGBP. You will recognize short-term capital gain or loss depending upon the WDV. I'll tell you how. Let's consider, and all of us know when it comes to the depreciation concept, every asset gets classified under block. It doesn't have an individual recognition criteria. It is just that everything gets under block. If you have machinery 1, if you have machinery 2, and if you have machinery 3, if it is 10 lakh, if it is 8 lakh, and if it is 2 lakh, the total 20 lakh. On this, you are going to charge 15% depreciation. Suppose it is not the 10% on the 15 lakh I'll calculate, on that 15% I'll calculate, on that 15%. No, you'll not do this. You'll do the direct block. It means whatever the asset you have sold within that block. Suppose you have sold this asset. Let's consider you have sold this asset for the same price, keeping it simple. How much would be the difference? 10 lakh. Suppose you would have sold it at 12 lakh, normally speaking. 10 lakh worth of asset in your WDV as per income tax, you have sold it for 12 lakh. How much would be my closing balance? 8 lakh. You will never recognize the profit or loss. You will never recognize the profit or loss. You will never recognize the profit or loss in that situation. PGBP, you will capital gain, you will never recognize the individual gain or loss which you get from selling a individual asset, depreciable asset. Only you can get gain only when you're selling your entire block as nil, is nil. That is, you have sold it for entire. That is, let's consider you have sold the block for entire 22 lakh. Now you have got 2 lakh rupees income. That is nothing but short-term capital gain. Correct. Suppose you have sold this machinery 1 and machinery 2. Machinery 3 is still there. Okay. And you have sold it for 18 lakh. 19 lakh. It will still continue to get that 1 lakh rupees as your closing WDV. It means if your entire WDV is 0, only then, that is your entire WDV is 0, that you have sold all the asset, or your entire WDV is 0, in that situation only you are going to get the taxability under this capital gain. Suppose you have sold all the assets. Okay, you have sold all the assets which is recorded here. That is, you have sold this machinery 1, machinery 2, and machinery 3, all the 3. But you have sold it only for 70 lakh in total. Now you will result in, as the entire block is 0, WDV block, entire block is 0, whatever you would get would be your short-term capital loss. Clear? In order to get gain or loss, your WDV should be 0 first of all. In order to get gain or loss, your WDV should be 0. That is, you should have sold the entire assets, all the entire assets in the block, or your WDV should be 0. Only then you can get your gain or loss. See, does the block cease to exist? Yes. Then full value of consideration in my first example was 22 lakh. If it is greater than WDV, then if the answer to this is yes, you have resulted in short-term capital gain of 2. That is 22 minus 20. Correct? If your short-term capital loss, that is, if no, the answer is no. That is, your full value of consideration in my example is 17 lakh, and your WDV is how much? WDV is 20. Difference between this will be short-term capital loss. And in this case, does the block cease to exist? Yes. Sorry, the block cease to exist? No. In that case, your WDV 20 minus your full value of consideration, my example was 19. Closing WDV would continue. You would not get any gain. There is no short-term capital gain, or there is no short-term capital loss. Okay. Keeping this point in picture, keeping this point in picture, let's move forward. Mr. Singhania Co, sole proprietor, owns 6 machines. So the block has 6 machineries put in use for business in March 23. Depreciation on this machinery charges 15. Okay, opening balance is given 8 lakh 50. 3 of the old machines were sold, and the second hand machinery 8 lakh 50,000 rupees has been bought. Second hand plant was bought. So the purchase total would be 17 lakh. Opening is 8.5, and your whatever you have bought is 8.5. Now the total is 70. Let's look into the sales portion also. Determine the claim of depreciation for AY 25-26. We already know how to do the calculation, the depreciation. Total you have 17. Is it before 180 days or after 180 days? It was purchased on 30th November. So it is going to be half rate of depreciation you would be providing. The sale consideration is 11 lakh. Total is 6 lakh. See people, out of this 6 lakh, how you would consider? You have 3 machinery, suppose. Okay. Assumption would be whenever you are selling a machinery, it would be out of the ascending order. That is, whatever you are buying first, you are selling out first. That is what the assumption you are thinking. Correct. So keeping that assumption in picture, out of entire whatever 17 lakhs, 11 lakh has been sold. First I'll assume out of 8.5, I have sold entirely 8.5. Remaining, I would have taken out from 8 another the purchases of whatever I've done. So this 6 lakh will be subject to half rate of depreciation, that is 7.5. Logical, no? 7.5. Next would be compute the capital gains liable for tax for AY 25-26. What is the capital gain that would be liable? See, you are not going for any capital gain because you still have WDV left. See, capital gain will not arise because the block of asset, whatever the asset we have, it's still existing. So there is no concept of capital gain here. What if has sold 3 machineries for 21 lakh? See here only we can see. Total is 70. Your sale consideration, if it is happened to be 21 lakh, what will happen? 17 minus 21 would be 4 lakh. You have resulted in short-term capital gain of how much? Short-term capital gain of 4 lakh. Correct? That would have been resulted in short-term capital gain. As your sale value is greater than WDV, that is full value of consideration is greater than WDV, your answer would be 4 lakh. Clear? Everyone understood? Mr. A, next question. This is the concept of section 50B, slump sale. Okay, I'll give you a very quick point of understanding of the slump sales and then we will do the question. It will be much more helpful. See, slump sale means you are selling that entire undertaking, entire unit as a whole. How would you consider the full value of consideration, people? Fair market value 1 or fair market value 2? What is this fair market value 1? Full, that is the fair market value of the whatever the asset which you have transferred. Fair market value 2 will be the actual sale consideration. Whichever is higher, you would take it as your full value of consideration. Cost of acquisition is net worth of asset minus liability. What is your asset? We will recognize. See, why do you have to consider the full value of consideration as fair market value 1 or 2? Suppose your actual sale consideration which you have determined is 20. Okay. We both have decided it is for 20 crores. Okay. But the fair market value of the asset, when you have totaled it, it is coming up to 35 crores. Think logically. You have a property of worth, let's consider some 10 lakh. If you're thinking of selling that property also, you will expect a minimum of 10 lakh. That is your fair market value of that property. Why would you sell that property for 3 lakh? Making sense? See, in order for the taxability to come in, this or this, whichever is higher. Correct? So it is going to be 35. Suppose this provision was not there and they would have just told your full value of consideration was actual sale consideration. What you would have done? What you would have done? You would have considered 20. Correct? This was loss of revenue for the government. The earlier, some years back, it was only actual sale consideration. This provision, later on they bought it. So it is going to be how much? 35. That is what you're going to record here. That is your answer would be 35. Correct? Done. Here, what would be your actual sale consideration? What will be your cost of acquisition? See, cost of acquisition determination, how you would do is very simple. Whatever the net worth, asset minus liability. Liabilities, all of us know. Asset means in case of depreciable asset, WDV as per income tax would be available. Take it. Self-generated goodwill, people self-generated goodwill, the cost of acquisition would be 0. So here also 0. In case of capital asset, all expenditure taken allowed under section 35AD, if you already have deduction and taken the entire deduction, Again, you would not take any cost of acquisition here. In case of other assets, it would be what? Book value. In case of other assets, it would be book value. You are going to consider everything asset minus liability you are going to do, and then you are going to do that computation. Okay, great. There's another point which I need to explain. I'll explain to you later. Mr. A is now illustration 10. Mr. A is a proprietor of Akash Enterprises having 2 units. This fellow has 2 units. He transferred on 1/4/2024 is 1 unit by way of slump sale. Total consideration is 25. Fair market value is 30. You only tell me whichever is higher. 30 lakh would be your actual sale consideration. Unit 1 started and the expenses is also considered. So 30 lakh minus 28,000 expenses you will reduce. Now we will get net sale consideration. You have capital information and you have asset information given. Own capital is there. Capital liabilities only you are going to subtract for cost of acquisition determination. Asset minus liability. Revaluation reserve you have. Discussion need to be done for revaluation reserve. Bank loan 70% of unit 1. 2 lakh into 70% will be for unit 1. 1,50,000 into 25% will be for unit 2. Very well. Land for machine unit 1 would given separately. Unit 2 is given separately, and unit 1 is given separately, unit 2 is given separately. Data set, other assets. Okay. See, revaluation reserve is created by upward revaluation of land of unit 1. Machinery, no individual value of any asset is considered in the transfer deed. Fine. Other assets include the patents of worth how much? 50,000 on 1/7/2022. On 1/7/2022, on which no depreciation has been charged. On which the no depreciation has been charged. The value of the machinery represents the written down value as per the amount and compute the capital gain. Okay. See, people try to understand the point over here. Okay. See, revaluation reserve, whatever is been created, understand one thing. Revaluation reserve is not considered under your the property. That is not considered under your land value. Why? How? Try to understand this with an example. Okay. Understand this with an example. Okay. Suppose let's consider you have bought some land. Land is some worth 1 crore. Okay. Some 10 years before you have bought a land. When you have bought a land, what would have happened? Let's consider you have bought this land for 1 crore and you had some liability side also 1 crore. So your balance sheet matched. You have no problem. After some 10 years, the value of this land 1 crore is now 10 crores. It means the value has increased to 10 crores means you have to increase it by 9 crores in order to bring it in your books. You are thinking, okay, let me bring it to fair value now. Can you do that? Yes, absolutely. In order to increase that 9 crore, if you just add this land like this, see, suppose when you have bought in year 1 the land, what would have been your entry? Land account debit 1 crore to bank account. This is what the entry that you would have recorded, correct? Land is your asset. Asset as debit balance increase. Bank is your asset. Asset as debit balance. It is decreasing. So you are crediting. Decreasing an asset, increasing an asset 1 crore. Okay. So now in the 10th year when you are recording this entry, if you want to increase your land, what you would do here? You would debit your land very well, 9 crore. Now it has resulted in 10 crore. You have to credit something, no, in your books of accounts. What you would credit? Can you credit bank here? You can't credit bank here because money is not moving out, no. Bank is your actual, money not moving out, you can't record. Now what you will record is that you will record an asset called as, you will record a reserve called as revaluation reserve. And this revaluation reserve will now be sitting on the other side as a revaluation reserve. Now your balance sheet matched. Clear? Can I say the revaluation reserve which is created has no money that moved out of your pocket? 9 crore rupees money has not moved out. It just brought it for the valuation purpose in your books of accounts. if money is not moved out of your pocket, department it generally doesn't give the deduction of from that, or the considered to be as the cost under your calculation. Understood the reason why it is not going to be considered? That is nothing but it is going to be subtracted. It is not going to be considered. Revaluation reserve 12 lakh. This is also has revaluation reserve effect to the extent of 3 lakh in unit 1. So for the purpose of my cost of acquisition in my calculation, out of this 12 lakh, 3 lakh I shouldn't consider. 9 lakh is the land value that I should consider. Clear? Done? See, when I'm calculating the net worth, it shall be, so first of all, let's go one by one. Fair market value of the capital asset or the monetary consideration, 30 lakh. Expenses have transferred. And net worth, when I'm calculating, land will be 12 minus 3. Revaluation reserve I will not consider. Machinery will be as it is. Debtor will be as it is. Patents, we will do it very soon. Other assets out of 150, 50,000 was to the extent of patent. So remaining was other assets. I had no problem. I have recorded. What about this patent which I have recording over here? That is asset. They have given a point. Other assets of unit 1, this include patent acquired on 1/7/2022 for how much? 50,000, on which no depreciation has been charged. But now I have to bring it to the correct value. No, they have forgot or they have not recorded. Very well, fine. Have to bring it to a correct value now. So what I will do, I'll bring this 50,000 to the current opening balance when it has been sold on 1/4/2024. I'll bring it to the opening balance of 1/4/2024. Very simple here. 50,000 rupees, whatever I have, that is going to be intangible asset. Patents are intangible assets. Allowable rate of depreciation would be 25%. 25% for the financial year 22-23 would be full rate of depreciation I would get. So entire 12,500 I would get. Whatever the answer. Again, next year I would get the full 25% depreciation. Whatever is the balance which I got as on 1/4/2024, that I would consider in my total asset value. And liabilities, though we already know how we have calculated this. And then now we have got the net worth. This is there in the question. This net worth, whatever I have recorded here, and I have got my long-term capital gain. Remember, how do you determine the undertaking as a long-term capital gain or short-term capital gain? Would be very simple. This is depending on whether your period of holding is more than 36 months, long-term, less than short-term. See, taxability amendment has happened, and the taxability is that long-term capital gain is taxable at 20% if the transfer has happened before 23/7/2024. If the transfer has happened on or after, then the long-term capital gain shall be 12.5%. This is an amendment. Taxability, though they have not asked in the question, whatever the long-term capital gain is there, see when is that happened? It has happened before, so the long-term capital gain 20% only will be applicable. Done. And so now we will do this illustration 30. Calculate the income tax liability for the AY 25-26 in the following cases: Mr.A, Mrs.B, Mr.C, and Mr.D. This fellow is a non-resident. This fellow is a non-resident, resident, and non-resident. Remember, for non-resident, the normal rate of under the normal provision, the slab that would be applicable will always be 2.5 lakh, up to 2.5 lakh basic exemption limit. The other 3 lakh and 5 lakh exemption is not applicable. In case of 115 BSc, you have no problem only. There is only one basic exemption limit, that is 3 lakh. Okay. And exhaustion and rebate would be applicable. Rebate concept would be applicable only for residents. It will not be applicable for non-residents. These are the primary things you need to understand. Okay. The total income other than the long-term capital gain for this is 2.4, 3.10, so much and so much. Long-term capital gain, assuming the transfer has taken place before, very well. 85,000 from sale of this vacant site. From the shares 10,000. 60,000 from the sale of agricultural land in rural land, and it is nil over here. You have to do the solution considering it under default tax regime and considering it under optional tax regime. That is nothing but your normal provisions. First we will do for normal provisions, then we will get into 115 BSc. See, residential status of this fellow is non-resident. And what is the basic exemption limit applicable? I told you it is 2.5. What is the asset sold? Vacant site. And whatever the other income which you have, whatever the long-term capital gain that you have, you can exhaust this 85,000, which is taxable at what price? Where is it? The LTCG. This is taxable at what price? 85,000 into 20%. As it is transfer is before, you have got the long-term capital gain of how much? 20%. However, you have 2,50,000 rupees basic exemption limit. No, correct. On that basic exemption limit of 2.5, this entire 2.4 is exhausted. And what is the amount of capital gain that you had? 85,000. On that remaining amount, as you are a non-resident, you will not be having the benefit of exhaustion of the basic exemption limit. You are directly recording that 85,000. 85,000 into 20%, 17,000. On that you will calculate HEC. You don't have any rebates. Clear? Now Mrs.B, she is also a non-resident and basic exemption limit is 2.5. However, she has other income of 310. However, long-term capital gain is how much? 10,000. Up to 1,25,000 exemption is available for everyone, not only for resident, non-resident. It is available for everyone. Okay. So, this 10,000 rupees though, they will not get because you have the 1,25,000 limit. Out of this remaining 3,10,000, you have how much? 2,50,000 rupees as the basic exemption limit. So the difference of 60,000 rupees, you are going to calculate your 5% of that, whatever 60,000 you have considered into 5%, you have 3,000. That is what you are going to get. How did you get this one? 3,10,000 minus 2,50,000 rupees you have got. Clear? Done. Similarly, for this Mr.C, he is 81 age. The basic exemption limit applicable is 5 lakh and he has got some 60,000 rupees from capital asset, sale of rural agricultural land. Rural agricultural land is not a capital asset only, no? So, where is the taxability coming in? And this fellow has a total income of 5,90,000. Out of this 5,90,000, he already has 5 lakh rupees basic exemption limit. I will remove that one. And on that remaining 90,000 rupees, I am going to charge 20%. As per the normal provisions only, not much fancy, 20%. On this one, he has HEC. As his income is already exceeding 5 lakh rupees, he doesn't have any rebate. Calculate of total tax liability. Now, in this case of Mr.D, which is a non-resident, this will also basic exemption limit. The total income is how much? 4,80,000. Out of that 2.5 lakh, you can easily exhaust here. On that remaining 2.5. So 4.8 minus 2.5, how much is it? 2.3. 2,30,000. On this 2,30,000 multiplied by how much? What is the percentage applicable? 5%. You are going to get 11,500 on that HEC will add and you will close. Okay. This is in case of normal provisions. In case of 115 BSc, everyone have the same basic exemption limit. Okay. Long-term capital gain, all of us know that is out of 2.5 lakh, out of 3 lakh, you can exhaust from the other income. But for non-resident, you can't say, okay, this 3 lakh rupees long-term capital gain also, I will not pay a tax out of it. No, you have the benefit of not paying tax only for the other income, not for the special rates of tax if you are a non-resident. So you have to pay the tax no matter what. 85,000. In this case of 85,000, as usual, we have done the similar calculation in the previous point. Same calculation would consist of. In this case of 3 lakh, 10,000 rupees is 112. So exemption is there. After that remaining 3 lakh 10,000 rupees other income is there. Exemption we have done. And what happened? Remaining 10,000 rupees, you have some 5% payable, that is 500. HEC will add and close. Remaining Mr.C, this fellow is a resident. Basic exemption limit, there is no 5 lakh limit and all. It is just 3 lakh for everyone. Rural agricultural land, there is no capital asset. There is no capital gain coming up. So 5,90,000 out of that minus 3 lakh, you do the tax liability, you will get the answer. So out of the last one, non-resident 3 lakh, basic exemption limit, you will subtract this, whatever the answer you get, you can do it as per the capital gain tax, as per the tax liability of 115 BAC and as per the normal provisions. Okay, so this is the detailed explanation of your important questions of illustrations and all the questions of your test your knowledge. And if you want the material of this, whatever you are seeing, this is available in my Telegram channel. You can go and get that, join over there and get that, all the free resources, all the amendments with relating to the direct tax. Okay, thank you so much everyone.